Welcome to Grass Academy. In this particular module, we're going to be explaining to you about Forex. Every little single detail you want to know about Forex. I know you may have some questions you're asking yourself, but this particular video is going to make you to understand Forex as a whole. Just take it as a summary of everything about Forex for you to understand. Alright, so let's get started. Now, what is Forex? Forex in short is foreign exchange. So we take Forex as the acronym that represents foreign exchange. Okay, now these foreign exchanges are they are just about different currencies of different countries coming together to make money. So now let's look more into it. Forex, in short for foreign exchange, is the global decentralized market where national currencies are traded against each other. Now let's go more into Forex trading. So I explained the concept of Forex. Now there's another word attached to this thing, which is trading. So now, what is Forex trading? Forex trading is the buying and selling of one currency for another in the global foreign exchange market to make profits. Of course, that's what I said. Now, this process involves trading currencies in pairs. All right, we trade currencies in pairs, just like, for instance, we have the naira going against the dollar. You're trading is either you're trading dollar for naira or naira for dollar. Okay, so now let's use a realistic explanation, a realistic life explanation to explain this. The same way whereby we go to the market to buy our clothes, our phones, foodstuff, things we want to eat, things we want to wear. Okay, different things in the market, right? That is the same thing in Forex trading. Okay, it's either you're buying one currency or you're selling one currency. So the Forex market is just like the physical market. Okay, so if you go to the physical market, let's say for instance there's nobody in that physical market that is selling, then you're not going to buy, right? And because of that, there's no market and there's no trading. I hope you know that people who sell in the market, the skill is called trading. So trading is about buying and selling. Trading is about buying and selling. It is just depending on what you are buying and selling. Okay, so you go to the market, for instance, you want to get some fruits, say for instance apple. You need a person who is selling apple in the market for you to buy. Now let's come back to Forex trading or the Forex market. That is the same thing that happens here. So when you see two pairs come together, it's either you buy one pair or you're selling one pair at the same time. But we'll explain that in more context. So let's continue. All right. So it is the world's largest and most liquid financial market, operating 24 hours a day, 5 days a week. So this information is very vital for you to understand. Okay, so the Forex market is operational for just 5 days. We don't trade on Saturday. The Forex market is not open on Saturdays or on Sundays. It's just from Monday to Friday. Why is it that? Because these currencies because this currency is operational by banks. Now recall that I said trading is about buying and selling. So there must be a seller in the market for you to buy. But in this concept, our sellers are the banks. They are the owner of the currencies. Okay, we have central bank, we have the World Bank, we have the Japanese bank, we have the China banks. Okay, so these are where these country currencies are, because they have their country banks where money moves the most, where money is distributed to the country. So that is just it. You get what I'm saying? So now, like the statement said, that Forex is the most liquid financial market. Why is it liquid? Because it's easy is easy to give you money, is easy to take money away from you. Okay, so all right, so let's go to the next one. So now, how does Forex work? Number one, Forex trading is always done in pairs, like Euro USD, where you simultaneously buy one currency and sell the other. I've already explained this before, but let me still touch on some important details like pairs. Now we have what we call pair of shoes, pair of socks. When we're talking about pairs, it means two teams becoming one. Okay, two teams becoming one. All right, but we'll look at pairs more detailedly in other models, where we're going to explain why Euro is at the front and USD at the back, how it operates if you want to buy Euro USD, which one is buying and which one is selling. So, but just know that Forex trading is always done in pairs, okay, where simultaneously you're buying one and selling the other at the same time. Okay, so let's move to the second one. Profits from price exchanges. Traders aim to profit by correctly predicting whether the traders aim to profit by correctly predicting whether the value of one currency will rise or fall against other currency. Okay, so that's what we do. We tend to try to understand the market, which one is bigger than the other one. Like for instance, we all know as Nigerians that USD is greater than Naira. And for other countries, I know that USD is the two currencies I know that USD is not powerful against is the Euro and the GBP. So we have other currencies, of course, USD has more, their currency has more power over them. So it is now left for you to decide and predict correctly which one is moving fast, is going to rise or fall at that particular time that you are analyzing the market. Okay, so that's how we make money. Now, for example, in the Euro USD pair, a trader might buy it if they believe the euro will strengthen against what? The dollar. So of course we know that euro is going to strengthen against the dollar, but at that particular time, is USD powerful than euro? If at that particular time you're trading that pair, USD is stronger than euro, it means that euro is going to fall, and then that is where you make your decision and then you sell. All you just need to do in this particular thing is to align with the direction of the market, because if you're trading against what the market is saying, you're going to lose money. So the idea is just to trade in the direction of the market. Now let's look at number 3. Like I said, the Forex market is decentralized. Nobody is controlling the Forex market. It is decentralized, totally decentralized, and operates 24 hours a day, 5 days a week, which allows trading to happen around the clock. Now, what are the key characteristics of Forex? The Forex market is the largest financial market in the world, with a daily trading volume exceeding $7.5 trillion, which provides high liquidity, of course. This means that Forex is a very volatile market. You get your money fast or you lose your money fast. Okay? Sure. So, another thing that this means is that this shows that that a lot of people are in this market. That means a lot of rich people, a lot of rich guys are in this market, because tell me who has all the money of $7.5 trillion, right? It shows that collectively there are different amount of people trading market. Even the banks, you get the banks, individuals, companies are trading this thing. Okay, so which makes or shows that, because this is where money is. Okay, this is where money is. So you just have to go into the market and get your own share. It's as simple as that. Now let's go to number 2 characteristics. It is a global and over-the-counter market, meaning there is no single central exchange. Okay, what this means is that when you go to market, you're trading and you're getting money. There's no middleman doing any work for you. Once you trade, once you know the direction you trade to get your money, the money is entering into your dashboard, of which you can also later withdraw. We will go deep into those details, but for now, let's stay here. Now let's go to number 3, the market operation. Unlike other markets, there is no physical location. Like I explained, of course, it operates through a global network of banks and traders. So like I said, the forex market is a collective action of different banks which are owned by their particular countries, which came together to form this thing. Okay, so they came together to build a system where they can be buying and selling each other currencies. Okay, now let's go to the number 4th one. Why some transactions are for practical purposes like international business or tourism. Most of the market is speculative, where traders buy and sell currencies hoping to profit from the price movement. Let's go to the 5th one. Currency values are influenced by economic indicators like interest rates, inflation, and political stability. This means that since we now know that these are banks or different countries coming together to trade forex, the life activities or the reality activities happening in each country affect that currency pairs. So if there's interest rates, if their interest rate is high, we know that this is a good currency and is going to gain strength. If that country like Nigeria is having inflation, we know that that particular currency is going to weaken. And then we also have things like war, things like political stability. All these factors influences the markets, influences the currency pairs. Okay, it is still the same thing in the physical market, whereby if there are holidays, it affects the markets. For instance, if there's war in the community or atrocities happening in the communities where there are killings, you find out that that particular community market is not going to hold. Okay, right? That is an influencing factor that happened to that physical market, and it's the same thing, but it's just that it's in the different. It's coming from a different view. Okay. Now let's look at the next one we have. We have the number 6 one is risks. Forex trading involves high risks, especially when using leverage, which can amplify both gains and loss. Now, on the normal, forex trading involves high risk. Now, there's what we call leveraging. Leveraging is your broker. There's a third party company which we call brokers, which acts as a middleman that helps to give you more money. They add more money to your little amount of money to actually be able to trade the financial market, because it is believed and it's said that your small $10, 15,000 naira, 20,000 naira will not be able to stand the amount of money trading on the financial market. So you cannot really trade directly. So you need these brokers to actually use their leverage system to add your money, so it can amplify your money, and then you get your gains or you lose your money. So that's how it works. The major market participants. Now, the forex is not random. Price moves because different players participate with different objective powers and time horizons. What does this mean? This means that what moves the market prices are people from different time horizons. For instance, we have different time. The time in Nigeria is different from the time in USA, different from the time in Australia, different from the time in Sydney, different from the time in anywhere around the world, right? Okay, so this actually affects the price movement of the forex market. So I'm going to be explaining that the more, but this is just you understanding the major market participants, people who play a role in moving the price in market. So let's go. Number one is the central banks. They are the market controllers. Of course, I told you the central banks have the highest authority in the currency market. The next one, okay, let's look at how they influence price. How they influence price? They influence price to the interest rate if the country is doing well, like I explained, the monetary policy, currency intervention, forward guidance. Okay, so for instance, when interest rates rise, like I explained, the currency strengthens, and when the rates falls, the currencies weaken. This is why currency can trend for months or years, right? Because the countries, they are doing well. You can never fight the central bank's direction. Your job is to align with their bias, not to predict them. Okay, so like that's what I said. Your job is to move to the direction of the market's bias. What is market saying at that time? Is it selling? Is it buying? So that is what you need to do. Okay, so this is a game of following the bank's direction. What are the examples of banks we have? We have the US Bank, which is the Federal Reserve. We have CBN, we have ECB, we have Bank of England, Bank of Japan, and lots of banks, like I mentioned. And number two, we have the commercial banks. Commercial banks are like the mini banks which operates under the central bank. They are the liquidity providers. Now, liquidity means money. Okay, because when something is can be easily sold out, it means that that thing can easily bring money to you. So in this forex market, we see liquidity as money, quick access to money. Okay, so example of these banks, we have the City Bank, we have the GT Bank, just like they say, mini bank. Okay, so what is the role in the forex market? The commercial banks are the backbone of forex liquidity. They facilitate currency exchange for government and operations, trade massive volumes daily, provide bid and ask price to the market. Because these banks are mini banks, they are owned by people. They are not the government bank. Now, the government bank is the main bank of the country. So these commercial banks are mini banks which are owned by people. And because they know that money is in this thing that the governments are doing, they join the government to trade money to get more money. Okay, and because of that, liquidity, which is money, is provided more into the market. As you can see in my former explanation, that forex is about $1.7 trillion. Okay, that's a whole lot of money. Now, why do they matter? They sit between buyers and sellers. They profit from spread and volume. They execute order for institutions and huge fund. Yeah, so where there's money, you go. Okay, if there's no place, like in reality, if there's no place that's going to provide you money, you're not going to go there. Now, as humans, we know that wherever there's money, we go. Now, let's look at the next one. We have the institutions and the hedge funds, which are known as the smart money. Who are they? They are pension, investment firms, pension funds, asset managers. We have the hedge funds. Okay, now the next one, let's look at their role in the market. They play trade for forex and long-term positioning. So now we have seen that from the first to the second to the third, all of them want money. So why wouldn't the forex industry be so profitable? Why wouldn't the forex industry be so easily to be liquidated? It's going to easily give you money because there are a lot of money into this thing. The rich are playing this game, the wealthy are playing this game. So why do you think that you want to be rich? So you want to do the things that rich people are doing. So why being scared about forex? Why don't just learn this thing once and for all? Now let's look at the next one. Now the next one is the retail traders, boiled down to you and me. They are individual traders. So we just come to use our small money to trade with these guys. So that's the advantage. Okay, you see that we don't even need a huge amount of money. That the forex market has given us a space whereby we can we can, soup or scoop our own share out of the market and use for ourselves. So you see that this is a very high advantage in this tech types of traders. Now we've explained everything about Forex, right? The concept of Forex, the people that are involved, and the reason why it is so fast to make you money. Okay, so now let's look at the type of traders. Who are the type of traders trading this market? Now traders are classified based on how long they hold trades, how frequently they trade, and how they interact with market movements. There is no best type of trader, of course. You just need the right style to personalize with you, okay, with you and your time, your availability, your emotional control, your capital size. So you see that Forex is flexible. It doesn't matter who you are, where you come from, where you are staying. I can be in Sanchez, or Zimbabwe, and I'm trading. It doesn't matter where I am. Of course, it doesn't matter your personality, whether you're black, whether you're white, whether your culture is this or that. It doesn't matter if you're trading in the night time, in the evening time, or the afternoon time. Okay, it doesn't matter. Okay, so all you just need to do is to get the right style that fits your personality and all these things I mentioned, and of course your capital size. You don't need $1 billion. You don't need 1 million of your currency. You don't need 100K. You just need a particular capital size that you can afford, so you can start now from where you are. So what matters is not accuracy but profitability. So you can trade with the small amount of money you have if you've learned these skills very well and scale from there. Okay, so that is how Forex is. Now let's look at this type of traders. We have number one, the scalpers. Who are these scalpers? The scalpers are traders who operate on a very low time frame, like 1 minute time frame, 3 minutes time frame, 5 minutes time frame. So their goal is not to catch like big market movements. Their goal is just to take money off within 1, 3 to 5 minutes, and then they leave the charts. Okay, that's who we call scalpers. So is your personality does your personality feel like you're not able to wait for the market to do some certain amounts of time before you can go out from the market? So you just need to decide, okay, but this is what I'm saying. Just get what I'm saying right now. Now let's look at the next one. The next one is day traders. Now, day traders open and close their trades in a particular day. They do not hold overnight. Just within that 24 hours, okay, you just want to take your trade just that day, okay? So if you, let me say for instance, you enter the trade GBP USD in the morning, it means that you're still going to close that trade that particular day. It might not be in the morning, might not be in the afternoon. You can close in the evening, but the idea is that you don't hold your trade overnight. Okay, now let's look at the next one. We have the swing traders. Now swing traders hold their trade for several days and even weeks. So swing traders can hold as two. So far you hold your trade to the next day, then you're swing trading. Okay, that is the idea. So as you can see, from 2 days to several weeks, that's for swing traders. And this type of trader, they deal on a much higher time frame, like 1 hour time frame, or I would say preferably 4 hours time frame to 1 day time frame. Now let's look at the next one. We have position trader, which we hold their trades for months or even years. So these position traders seem like an investor, but in forex market we call them position trader, not investors. Okay, so let's look at the next one. Okay, the next one, we have the automated traders, which are the robots. You hear robots trading. Okay, of course we have to give them a space because there are some people who do not really know anything about trading manually, but they buy bots and these bots, these computer programs which are automated by the people who made it, makes money for them. Okay, yeah. So you can choose anyone that you want to be. Now, finally and finally, for this section, this is the last thing we're going to be looking at, which is understanding pairs. I said before that we're going to come back to this thing so that you can finally understand what we're talking about when we talk about what pairs, because it's very, very essential in the forex market. You're always going to be hearing pairs this, pairs that, gold pair, silver pair, USD pair, just like that. Okay, so now in this forex pair we have three types of pair: major pair, minor pair, and exotic pairs. I'm going to teach you guys and explain in short for you guys to understand more about this. Now, what is a pair? Pair are two things that match and are meant to be used together. That is the idea of pair. Why are they called currency pairs? They are called currency pairs because forex trading involves exchanging one pair for another, and this trades always involves two currencies. Okay, a base currency and what a quote currency. So just relax, I'm going to explain that for you. The price of the pair shows how much the quote currency is needed to buy 1 unit of the base currency. Now, for instance, we have Euro USD, which means that 1 euro is worth a certain amount of what? Dollars. Now, this means that what this means is that the base currency is the one that is on the front. So euro in this particular pair, euro is a base currency, right? Euro is the base currency, and the quote currency is USD. So any pair that is at the front is called the base currency, and any pair at the back is called the quote currency. Let's look at more explanation about this. In currency pair, the base currency is the first currency listed, and its value is what is being expressed. Now, which means that since the base currency is bigger than the quote currency, okay, since the base currency is bigger than the quote currency, it means that the base currency is always 1 unit, but the quote currency is the price that is showing on the screen. Now let's go to that particular. Let me show you an example on the screen of what I am talking about. Okay, now let's look at this Euro USD. Euro USD pair. Now this is what I mean. This is what I mean. Let's look at this. It means that Euro USD is 1 and Euro is 1 unit. Why? This price is here. This price is showing on the screen here is for USD, which means that 1 euro is equals to, this is the current price of Euro USD in the market. 1 Euro USD is equal to 1.17300. Now let me take that again. What does this mean? We know that the actual value of our base currency is always 1. Okay, but it's the quote currency that is showing the price. That's what it means. So Euro USD is 1 to what? 1 to 1.17310. Now let's look at this. Let's look at this on the Google. Sorry, let's go to Chrome and let's look at this. Okay, so what is the value of USD to euro? Or let's do this. What is the value of euro to USD? So are you seeing that 1 euro is equal to 1.17 United States dollar? What is our price showing us? 1.17. It's as simple as that. I hope that this particular explanation makes you to understand. So always remember that the base currency is bigger than the quote currency, and the base currency is 1, is always equal to 1, while the quote currency is what is showing the price of the chart. Okay, so let's look into more. We have the major pairs. Let's look into more. We have major pairs now. You've understood what pairs are, you've understood base currency, and you've understood quote currency. Now, what are major pairs? Major pairs in the forex market is mostly frequently traded and highly liquid currency combinations in what currency? In the USD currency. Now, any pair that carries USD, that's what it means. Any pair that is involved with USD is a major pair. Is a major pair. Why? Because USD is a major currency. Okay. So what are the example we have? Like I said, are you seeing any currency at all involved with USD is a major pair? We have Euro USD, we have USD JPY, GBP USD, AUD USD, USD CAD, USD CHF, and NZD USD. And each of the pairs, they have nicknames, so you just go ahead to look for the nickname of them. Now let's look at the characteristics of these major currencies. Major currencies are known for their high liquidity and high spread, which means high trading volumes and minimal differences between bid and ask prices respectively. Now, what this means is that these particular pairs are good to trade because since they are involved with the US dollar, it means that a lot of people are interested in them to trade with them because they are involved with a good market, a good country currency, which is the USA, right? So that is what this means, because it's involved with USD currency. It provides high liquidity. It has tight spread because a lot of people are in the market, so it makes the spreads to be tight so that people can be able to trade them. It will give people the willingness to trade them. Okay. Now another meaning for high trading volumes and high liquidity is that the market moves, that there's a reasonable amount of movement in the market. The second one is that the US dollar is always included as it involved in most forex transactions. Of course, the US dollar is involved in a lot of online transactions. Okay. The third one is they offer market transparency due to the available economic data and are generally less volatile than the exotic pairs, just like I explained that because they have high volatility, people are interested to work with them. People are interested in where the money is than where the money is not. Now let's look at minor pairs. Minor pairs are forex currencies that do not include USD dollar. So it could be two good countries that are good, but so far it does not involve US dollar. It is a minor pair. That is what minor pair means. Okay, so some of the combination you can as well also combine them yourself. Okay, so far it does not involve USD, then it's a minor pair. Now we have Euro GBP, we have Euro JPY, we have GBP JPY. We also have CHF JPY or JPY CHF, or you can do Euro CHF. You can just form different pairs that are not USD to form a pair, and then you search for them. But just know that those particular pair falls under minor pairs. Now let's look at this minor pair. They are made up of two currency excluding the USD. These characteristics, like I mentioned. Minor pairs are lower liquidity and wider spread. Yes, they have a little bit wider spread compared to the major pairs. Why is this? Is because some people don't really look into them since they are not major pair. but they also have liquidity, and they have their spread is much more manageable than the exotic pairs. Then number three, they can move more volatile than the major pair, offering potential for high profit. This means that they are still a good pair to look into, since it is something that people are interested in. Of course, it's not only the US that is doing well as a country, we also have other countries doing well. So you can also trade minor pairs and they'll give you good money. But just know that since they are not a major pair, they have less wider spread than they have more wider spread than the major pairs. Okay, so another example of the minor pairs are Euro GBP, Euro JPY. We have GBP JPY, Euro AUD, and Euro CAD. Now let's look at exotic pairs. Exotic pairs in Forex are the combination of a major currency and a currency with a smaller economy. For instance, we have USD Naira or Naira USD. So in this particular exotic pair, it doesn't matter if it is a USD pair combining it or a non-USD pair combining it. But the major thing we are looking at is that that particular country has a smaller economy. Their country is not really doing well. So that is just about it. Now let's look at the characteristics of this exotic pair. It's a one major currency. Like I said, it's paired with them. It doesn't matter if it's USD or a currency that is doing well, like the Euro and JPY. The second one is that generally they have higher volatility due to factors like political instability. So which means that since these currencies are not doing well, their spreads are going to be high. They look at it here. They have lower liquidity, means there's less trading volume compared to the major pairs and the minor pairs. Of course. So I'm going to show you guys what spread are later. You're going to understand what spread are. But just know that spread in the market is what enables you to enter the market at that particular time when you're seeing the price, where the price at. Because there are sometimes when you enter the market, if your spread is wide, you're not entering the market at that particular time. It's going to take you more below the market price. So that is the meaning of spread. You can just imagine, but I know you understand every other thing. So these are some examples of exotic pairs. Okay, so we have come to the end of model 1. I hope you found value in this particular model. See you in the next one.